In this video, I'm going to be talking about mutual funds and ETFs. We'll go over the similarities and the differences. You know, these are two commonly used investment vehicles, and we get questions all the time. What's the difference? ETF, what does that stand for? What does it mean? How's it different from a mutual fund? Just all different versions of that question on a regular basis. So we figured, why not make a video, show you what's similar between the two, and show you what's different. Now, mutual funds have been around since 1924. They've been used for quite a while. ETFs, on the other hand, came into use a bit later. In the 1990s, they really started to gain popularity, and they've grown exponentially since then. Let's take a look at each of these. Let's talk about some of the similarities between ETFs and mutual funds. First, they both can be great at providing diversification. So you can pick up a share of an ETF or a mutual fund, and in that share, you'll have a number of investments within it. They can be stock-based or bond-based. They can be split up a whole number of ways. It could be sectors, industries, could be based on company size, large cap, mid cap, small cap, all different varieties of both mutual funds and ETFs. Now, there are also active and passive versions of each of these investment vehicles. On the active side, there's going to be either a manager or an algorithm making investment decisions on your behalf. On the passive side, usually these funds look to mirror an index, and there are a whole range of indices. And the idea here is that you want to have as little tracking error as possible relative to the index that mutual fund or ETF is tracking. All right, now I want to point out something else to you. There is a company involved in this process. A company goes out and buys various investments, underlying investments, and builds these shares, whether it's a mutual fund or an ETF. And in turn, that company charges a fee. That fee is an expense ratio. So pay attention to which company is putting your fund or ETF together and what that expense ratio is, because ultimately that can have an impact on your investment performance. We just looked at the similarities between mutual funds and ETFs. Let's talk about the differences for a bit. First of all, they trade very differently. A mutual fund trades at the end of the day, at market close. All shares are bought and sold from the investment company themselves. That means that any buyer or seller of a mutual fund is going to get the same price on any given day. An ETF, on the other hand, is trading throughout the day. There's a bid and an ask, and shares are going to change hands at different prices between market open and market close. Now, something else to pay attention to on the mutual fund side is that there are different share classes even within the same fund. So mutual funds do have a ticker symbol, just like ETFs, but the same fund may actually have several different ticker symbols to signify different share classes. That can be A, B, C, some institutional classes. There are also different share classes used within retirement plans. So pay attention to which class you're buying. That can have an impact on the fees to get in, fees to get out, and even the expense ratio while you're in that investment. So watch out for that. The other thing I want to point out is systematic contributions are handled differently on the mutual fund and the ETF side. So a mutual fund does a very good job of handling a recurring purchase at a specified amount. So you can say, I want to buy X amount on this day every month and just have it automated, have it repeat itself. The mutual fund does a good job there. The ETF may incur some trading costs as you look to buy or sell shares on a monthly basis. So if you wanted to repeat that process monthly, even if you had free trading, it'd be a bit tougher to automate. You'd have to be specifying a quantity of shares to buy rather than simply a dollar amount like you would on the mutual fund side. Last thing I want to point out here is that there are some different tax ramifications of owning mutual funds and ETFs. I'm not going to get into specifically what they are because we don't know your tax situation, but just understand that each of those has the ability to generate some taxable income and taxable events to you, even if you haven't sold those investments. So you could be buying and holding. At year end, you could still see some tax impact. So read into that a bit. When you look at these, there's pros and cons of each. There's a wide range of both mutual funds and ETFs out there. And just know that if someone's talking to you about investments and they're looking at building a diversified portfolio for you, both of these could work together as tools within your portfolio.